Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of corporate finance and give you the real story behind the numbers. Today we're diving into Aquaron Acquisition Corp, its latest quarterly report, and let me tell you, this one has some interesting twists and turns, especially when it comes to their financial health and future plans. So, what's the big picture here? Aquaron Acquisition Corp is a shell company, which means it exists primarily to acquire another company. They are in the tricky business of trying to find a target for a merger, and their financial statements really reflect this early stage, uncertain path. Let's start with a look at their financial health, their balance sheet. As of the 30th of September 2025, Aquaron had total assets of about $1.57 million. That sounds reasonable, right? But here's the catch. A huge chunk of that, over $1.37 million, is sitting in a trust account, basically set aside for potential future business deals. Their actual cash on hand. It's a meager $3,317. That's less than a lot of us might have in our checking accounts. And their liabilities, the money they owe, are significantly higher than their readily available cash. They owe over $4.19 million just in current liabilities. That includes a pretty hefty chunk of excise tax payable at nearly $740,000. This is a consequence of some stock redemptions they've had to make. Now, this next line item is super important for a company like Aquaron. It is called common stock subject to possible redemption. As of the 30th of September 2025, this amounted to over $1.37 million. This represents shares that public stockholders can redeem for cash. It's essentially a liability because the company might have to pay out that money. And what's interesting is how this number has shrunk dramatically from over $9.2 million at the end of 2024. This shows a lot of folks are cashing out their shares, likely due to the company's ongoing challenges in finding a deal. Then we get to the accumulated deficit, which is basically the total losses the company has incurred since its inception. It's sitting at a pretty substantial negative $6.52 million. This is typical for companies in this stage, but it highlights the financial drag of just existing without a successful business combination. Looking at their income statement, which shows how much money they made or lost over a period, we see a consistent story for the 3 months ending September 2025. They reported a net loss of about $81,000. For the 9 months ending the same period, that loss ballooned to over $621,000. Now, where does their income come from? It's mainly from interest earned on that money they have parked in the trust account. For the 9 months ending September 2025, they earned almost $159,000 in interest. This is their main lifeline, showing they are not generating revenue from operations because, well, they have no operations yet. When we look at their cash flows, the net cash used in operating activities section shows us how much cash their core business operations are consuming. For the 9 months ending September 2025, they used over $35,000 in cash just to operate. This again emphasizes they are not generating revenue from a business. The cash flows from investing activities are quite telling. A massive $8.17 million was withdrawn from the trust account for public stockholder redemptions during the 9 months ending September 2025. This is a huge number and explains why their cash in the trust account has dropped so dramatically. Basically, a lot of investors who bought into the IPO are now cashing out their investment. It's also important to note the loans and financing they are relying on. They have outstanding promissory notes to entities like Future, amounting to over $260,000 as of September. These loans are crucial for keeping the company afloat while they search for a business combination. Now, this is where things get particularly concerning for Aquaron. They've had significant trouble with NASDAQ listing rules. They received notices that they don't have enough public shareholders, and trading of their stock was suspended. This is a serious red flag, indicating that they might be delisted from the stock exchange. Being delisted means their shares will trade on a less regulated over the counter market, which usually makes them less attractive to investors and harder to trade. The report explicitly mentions substantial doubt about the company's ability to continue as a going concern. This is a very strong warning. It means the company's financial situation is so uncertain that to raise serious question about whether it can survive for the next year, they have until January 2026 to find a business combination. If they don't, it's liquidation time. Here is another interesting point, the excise tax liability related to the Inflation Reduction Act. They've recorded a significant excise tax liability, over $739,000 as of September 2025, including penalties and interest. This tax applies to stock repurchases and redemptions by companies. It highlights the increasing regulatory and tax burdens that can affect companies, especially those whose business involves a lot of stock redemptions, like SPACs. When we look at earnings per S-share, the numbers are pretty stark. For the redeemable shares, which represent the public shareholders' earnings per S-share, are positive. But this is largely due to how the accounting works with redeemable stock that is presented as a liability for the non-redeemable shares, which is essentially the company's own equity. The loss per S-share is negative, showing the ongoing financial losses. For example, for the 9 months ending September 2025, the loss per non-redeemable share was 45 cents. Let's revisit that common stock subject to possible redemption number. It went from over $9.2 million at the end of 2024 down to just over $1.37 million at the end of September 2025. This massive decrease means a lot of public shareholders, perhaps sensing the challenges, cashed out their investment. This significantly reduces the amount of money the company might have to pay out if they don't find a deal. But it also points to a lack of confidence from their own investors. In their management discussion, they are very clear about the risks. They acknowledge persistent inflation, market instability, and geopolitical events as potential threats. They also highlight the ongoing search for a business combination and the significant costs associated with it. The management itself states that the company continues to incur significant costs and that there is no guarantee of success in finding a business combination partner. And then there is this critical part about their controls and procedures. The report states that their disclosure controls and procedures were ineffective as of the 30th of September 2025. They identified material weaknesses in their internal controls, particularly in overseeing and disclosing related party transactions. This is a serious governance issue. It means that the company's internal processes for ensuring accurate financial reporting are not robust enough, which can lead to errors or even fraud. They are taking steps to fix this, but it's a significant concern for investors. Now, let's step back and look at Aquaron Acquisition Corp from a more strategic viewpoint. The story here is one of a SPAC struggling to fulfill its purpose. A SPAC's main goal is to merge with a promising private company and take it public. Aquaron has clearly had a tough time finding such a target. The massive redemptions by public stockholders are a strong signal that investors are losing patience or have lost confidence in their ability to execute a successful business combination. The delisting from Nasdaq is another huge blow, making it harder to raise capital and signal to the market that the company is performing well. The company faces significant risks. The primary one is their ability to complete a business combination before their deadline, which currently appears to be January 2026. If they fail, they will liquidate, and investors will likely get back less than their initial investment, especially considering the administrative costs and the excise tax liability. The material weaknesses in their internal controls are also a significant concern, raising questions about the reliability of their financial reporting and overall corporate governance. On the positive side, they do have some cash in a trust account and the support of certain lenders like Future and Bestpath, which is helping them extend their operational runway. These loans are often convertible into equity, further diluting existing shareholders. In my opinion, Aquaron Acquisition Corp is in a very precarious position. The odds of a successful business combination appear low, given the current financial state, the delisting issues, and the lack of operational revenue. The company is essentially burning cash while trying to find a deal, and time is running out. The material weaknesses in their internal controls are a serious red flag that cannot be ignored. This is a classic SPAC cautionary tale, where the initial excitement of going public quickly fades without a strong execution strategy and a viable target. That's our deep dive into Aquaron Acquisition Corp's latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps, and subscribe for more corporate deep dives from Corporate Decoder, and don't forget to join our Discord community, linked in the description. We're building a great space to discuss these filings and more. Thanks for watching, and we'll see you next time.